Hello, good morning, everyone. My name is Ash Shanab, and I am the head of EMEA here at RFI Global. Once again, welcome to our What UK Consumers Want from Their Banks webinar. We're really thrilled to have you here this morning. Last week, we had a breakfast event celebrating the launch of our new product, Orion. This is a UK consumer banking product, and we've had a really insightful conversation with various leaders in the financial services industry in that event. As a result, and at the back of the event, there was a high demand by those leaders for us to share the insights with the wider audience so that their teams have access to them. So this is why we decided to run this webinar. We're really excited about it, and we think that we're going to have a really good conversation today. The agenda of today is going to be we will present you with the insights for about 20 minutes, and then we'll have a Q&A session for about 10 to 15 minutes. Please feel free to post your questions throughout the session. Use the Q&A button on the lower right corner. And then if there are any questions that we can't address today, we will be able to follow up with you after the webinar. Without further ado, I would like to hand over to my colleague, Hubert Petka, who's also our group director and one of our in-house experts in consumer banking. So looking forward to seeing you at the end of the session. Over to you, Hubert.
Thank you, Ash, and thank you everyone for joining us today. As Ashraf mentioned, I will spend the next 20 minutes walking you through some of the key highlights we have seen for this initial run of analysis on this new data set that we have here. I'm speaking to 4,000 consumers every 3 months, 16,000 across the year. I have a couple of, I guess, key themes that I would like to walk you through and showcase some data. We start with talking about how consumers are currently managing or navigating some of the financial constraints and financial difficulties that we're seeing. Obviously, we're starting in a pretty downbeat message in a way, but what I wanted to emphasize here is that despite the obvious financial challenges consumers have to deal with, we have seen a very robust activity in the market, and that's what I want to really focus on today. Then I will move on to speak about fragmentation of financial relationships. I want to see how and showcase you how digital-only providers have been expanding their reach and share of the market and how they're targeting customers. That's a really key focus here. So what I will talk to you about is, two things really. Is that big six banks, so those big traditional banks, still really maintain a tight grip on primary relationships in the market, but we see consumers really shopping around for products and turning increasingly to digital-only propositions and seeing them really as a viable solutions to supplement products from traditional banks. And the final theme today will be really around decision-making process of consumers in the market. So I want to focus particularly here on the role of incentives and rewards in shaping consumer choice. You see, it's not entirely new topic in the UK, but what we have seen over the last couple of years, particularly over the last year and a half, is that rewards and incentives have become a really key trigger to switching activity, switching primary banks, and consumers are not just simply motivated by those rewards and incentives when choosing their providers, but we also see that having a good, comprehensive, and attractive product as a rewards proposition has a potential to boost engagement between financial institution and a customer. So let me start with the first one here. And there's obviously a lot of information out there, both primary sources, secondary sources, focusing on the topic of consumer finance and the fact that obviously consumers have struggled over the last couple of years. So I wanted to summarize it with a couple of key data points and insights here. So we particularly focus on liquid assets of consumers and the savings. And this data that we have here really draws a pretty downbeat message. But essentially, what I wanted to say here is that, despite all of this, we see a pretty significant activity among consumers still. But let me just focus on this first. So if you look at savings, we know that viability of saving as a product has increased over the last couple of years. So when you speak to consumers in the UK these days and we ask them about which products they would prefer to use to hold the excess cash or to save in, the popularity of savings has increased. And not just among the key segments that traditionally have been using savings, but we also see an increase in popularity of savings among younger segments. So if you look at, Gen X, so Gen Z, millennials, these consumers do not remember the times where interest rates are higher, when you could get a decent return on your savings account. That obviously has changed over the last couple of years. But obviously, those intentions were confronted by economic forces, let's put it this way. So what we see in this graph in here is that if you look at people's intentions to save, represented by this yellow line running through the chart, those have been increases. They had started increasing in 2022 as interest rates increased as well. So you saw pretty steady and ever-growing intentions to increase saving. But at the same time, you can see that average balance in the primary savings account has come down pretty dramatically, I would say. So if you look at this column chart, back in second half of 2022, an average consumer will hold around 15,000 in the primary savings account. We see, just to mention one other thing here, is obviously this is an average figure for the market, heavily influenced by often older, more asset-rich consumers, but still represents a good data in the market. But if you look at this data and how this has changed over the last 2.5 years, you can see a steady decrease in average savings balance. So it has decreased by about a third between the second half of 2022 and the second half of last year. And this really coincided with more and more people dipping into their savings to sustain their lifestyle, to sustain their everyday spending. So this is represented by the red line in here. And what you see in the data, that proportion at the end of 2024 at 49%. This is the highest level in 10 years. So higher than during the pandemic, and higher at any point since 2013. So that's one, I would say, story in here. So savings intention is pretty robust given the higher returns, but at the same time, people having to dip into the savings to sustain their lifestyle. What's I think also pretty stark in here is that if you look at the financial position that consumers had at the end of last year, in our data, we saw about 1 in 5 consumers ending 2024 with no liquid assets to the name. So very significant number. And those are basically people living from paycheck to paycheck, very vulnerable to different sort of forces and circumstances. And obviously seeing this at this level, 1 in 5, is pretty stark. The other thing as well here, just before I move on to the other one, is that when we look at the cost of living crisis, the cost of living challenges, we know obviously the interest rates or inflation, sorry, more so than interest rates, have eased over the last 12 months. We still saw that at the end of 2024, around 80% of consumers told us that they had to adjust how they manage their money, how they spend the money in the face of higher costs of living. So that's the story of consumer finances. But what I want to stress here is that despite all of these pretty obvious challenges, consumers have been pretty active. So if you look at average consumer, typical consumer in the market, they would hold on average around 7.2 different financial products, which is a pretty comprehensive and extensive portfolio of different financial solutions. That number has come up since 2022. There are 2 key products really driving this. So number one is savings. And I think, it's related to the story that I presented earlier on about higher savings intentions. But given higher returns on savings accounts, we had about 1 in 3 people, some 32% to be precise, telling us they have opened a new savings account in the last 2 years to capitalize on higher returns. So that activity, the product activity and searching for new solutions have been pretty robust. I think the other thing I find it quite reassuring and positive is that, we often speak about consumer intentions being one thing and actually the actions and the part of them they follow through being completely different thing. In here, in the data set, we're seeing that intentions and actions moved in tandem. So on the right-hand side, you see this yellow colored box with product intentions or appetite to take up additional products over the last couple of years. And you see that in 2022, the intentions jumped up very significantly. And that really corresponded with the increase in average number of products we recorded in 2023. So consumers remain really active and will remain active moving forward as well. So what we saw at the end of 2024 was that 26%, so a quarter of consumers, looking actively at new financial solutions. So there's people who are eyeing new products, who are pretty confident they will need additional financial products in the next 6 months. Again, this is driven by savings. So, despite also the fact that interest rates on savings have started to come down amidst some of the cuts that we saw from Bank of England last year and expectations of further reductions next year, but savings continue to be a very popular product in this environment. And I think the other element here that's also important to call out is that those product intentions are not a universal, are not evenly spread across the market. You see quite clearly in this data that it's mainly that Gen Z and millennials will be particularly active in the next 6 months. So we see around 40% of Gen Z and just under 1 in 3 millennials looking at new product solutions. I think that savings account, and the activity in the savings space, it's really interesting because consumers are telling us directly they're taking up new products to benefit from higher interest rates. But at the same time, if you look at how many consumers hold savings paying out 3% and more, it's only a third of consumers. And if you really wanted to shop around and go for savings that's simply on that one key criteria of interest rate, you could definitely find something above 3% mark, but only a third of the market are taking advantage of those products, which is still very big jump from where we were in 2022, when it was only 4%. But it shows you that there are other factors consumers looking at as well when evaluating different savings propositions, and don't simply decide on this single factor of interest rates. So that's the activity, as I say, very robust despite those financial challenges and many consumers had to grapple with over the last couple of years. How this has impacted share of wallet and market penetration, market share more broadly. A few things here. So first of all, if you look at share of primary banking relationships, and in our data that's self-defined, although there's a very close link between main current account and primary banking relationship, but big 6 banks really hold a pretty tight grip on that. So 84% of primary banking relationships still being held by one of the big banks in the market. And I think the other element here that which is important, I think, to call out is that share did not really change that drastically over the last 10 years. If you look at the data from 2013, it was still around 80%. So, despite the fact that consumers do look at digital-only propositions and do shop around often a little bit more than in the past, they still gravitate towards the big 6 banks. In terms of the neobanks, and in here we don't look at the broader universe of digital-only providers. We are focusing squarely on neobanks, the likes of Monzo and the likes of Starling, Chase. So the share of those banks, so the share of primary relationships did go up over the last several years. So we're looking at 6 to 5% currently. But what we see in our data is that their increase did not come at the cost of the bigger banks. It often came at the cost of the smaller providers. So tier 2, tier 3 banks were more likely to lose customers to primary customers, to neobanks, than the biggest banks in the market. But consumers are, what I said earlier on, they are shopping around for solutions. They're actually very comfortable using different providers, and often, pretty high number of different providers. So in 2024, at the end of 2024, a typical customer in the market held a relationship with just over 5 different providers, so 5.3 to be precise. That's an increase of 1 compared to where we were in 2014 when it was at 4.3 providers. It doesn't seem like a dramatic increase, but still it shows you that every person in the market has on average added a new financial institution to the portfolio of the different providers they have a relationship with. And big banks are not doing well at just capturing primary relationships. They're also doing really well at capturing share of liquid assets. So for us, we define liquid assets as current accounts, savings, liquid investments. On average, Big Six would hold around 54% of that wallet. There are some really strong nuances here across the different segments. So more affluent consumers will be more likely to spread in liquid assets across different types of institutions. We also see a big drop by generation. So baby boomers particularly, they'll only hold about 35% of the assets with Big Six bank. That's mainly driven by the relationship with building societies, particularly in the savings area. Many of the consumers would hold savings outside those big providers, often for the primary reason behind this is trying to benefit from higher interest rates as providers tend to offer on savings compared to traditional bigger banks. The other thing we also see in the data is that when we try to understand the reasons driving consumers to different types of institutions, so why a typical customer would use a big bank as their primary institution, it's less likely to be driven by parts of proposition or digital capabilities or a particular product. It's more to do with longevity of the relationship with the brand, with the banks, big banks still capturing salary deposits. I think that's the really primary factor in many ways. What we see in our data is that a lot of consumers are open to be holding multiple different relationships. They still often trust bigger banks with the salary deposit, and having that main current account, particularly when it's also capturing salary deposit, that continues to be really the key anchor product in the market. It's much easier to cross-sell additional financial solutions if you have that relationship with your customer. The reasons for choosing neobank are very different. You can see two factors primarily here driving this. Digital capabilities, particularly mobile app, a really key factor motivating consumers to use a neobank as the main bank. We also see convenience. So they see them as more convenient to bank with. Though they don't have obviously branches or branch networks, the digital capabilities, the onboarding process, in eyes of many consumers, they're just much more convenient and streamlined compared to what they would expect or what they experience from a bigger bank. The other aspect that I wanted to focus on here is that, despite the continued dominance of big banks in terms of primary relationships, we do see consumers being open to shop around and hold products outside the main banking relationships. The chart that we have on the bottom of the slide looks at the types of different products consumers hold. They're presented here by this blue line. In other words, 89% of consumers will hold an insurance policy, 81% savings, 60% credit card. And the yellow one shows how many of these consumers hold those products with the main bank. So what you're seeing here is that current account still in the majority, pretty much all of the customers will hold it with the main bank. Off the back of what I said a couple of seconds ago, the current account continues to be the key anchor product. But elsewhere, you see that consumers are really open and comfortable shopping around and going to institutions that are not their main bank. It starts with savings. You can already see quite a substantial leakage in there, even bigger in credit cards, but that expands further when it comes to investments, mortgages, personal loans, where consumers do really typically opt for a proposition they feel is more attractive, regardless of whether this is a product offer by their main bank. So they will just choose a provider they feel has a more attractive proposition. In terms of the digital-only providers, so there are two things in here. If you look at how these institutions grew over the last 7 years, I mean, we're looking pretty huge increase in the penetration of them. So 16% in 2018 up to 50% in 2024. So we're looking at a threefold increase. But you will see very clearly from this data that the growth of the digital-only providers has plateaued over the last 3 years. So it has only gone up from 46% to 50%. But at the same time, we did see particularly neobanks really expanding their propositions, maturing in many ways as well, being more often focused on not just building the customer base and acquiring new customers, but boosting engagement and deepening relationship with the customers. And we see that reflected in our data. So although the share of neobanks might have the growth in share of neobanks might have slowed down. If you actually look at some of the metrics and customer metrics and behind those institutions, they've increased quite substantially. And the two things here we wanted to highlight particularly is the number one is the share of primary debit card market. So back in 2020, neobanks controlled 1% of that. So 1% of consumers will hold a primary debit card with a neobank. At the end of last year, it was 9%. So we're looking at a ninefold increase in here. And that shows you that, although consumers often still prefer to keep the salary with traditional bigger bank, they are more prepared to be using those neobanks for the everyday spend, for the everyday banking needs. The other element, which is I think also really interesting here, is that if you look at spend on the main debit card and how this differs between Big Six and neobank customers, those using neobanks are now actually spending more a month on the debit cards than those using Big Six. So the difference here is about 20% higher spending with customers of neobanks than the customers of Big Six. So I think this shows you that, if those banks and when in a situation where they're able to encourage consumers to interact with them more regularly and use the payment products as the top of wallet products, they're actually really good at capturing share of spend, capturing share of primary relationships as well. And the growth of digital-only propositions, we know that those propositions are more attractive and more appealing to younger consumers. That's always been the case. But I think the other element here, which is perhaps more interesting, is the fact that more affluent consumers are often also more likely to be attracted to this proposition. So if you look at the uptake of digital-only providers, so that's both neobanks, but also all the other payment investment providers, Klarnas and Wise and so on. So among mass affluent consumers, we can see 56% using a digital-only proposition, against 46% among lower mass market segment, and the usage of neobanks 28% against 20%. So you can also see that the appeal of those institutions, of those providers, is higher among not just younger consumers but also more affluent consumers as well. And I've spoken about some of the factors driving consumers to neobanks. I've spoken about the convenience, about the mobile app, but the main aspect, I think, enabling these providers to increase the market share is the growing digitalization of and among UK consumers. So we know the mobile app uptake penetration had been increasing steadily over the last several years, but also the share of banking consumers do via mobile apps have increased pretty exponentially as well. So back in 2021, if you look at an average consumer in the market, around 35% of their overall banking was done on a mobile app. Fast forward to 2024, it's 46%. So nearly half of the banking is being serviced through mobile apps. I also wanted to quickly mention about branches. I think it's important because we saw pretty dramatic a drop in the usage of branches around pandemic. They have recovered since. Maybe they're not at the same level as they were, and obviously that the volume of interactions has definitely dropped. But simply, if you look at number of consumers using branches monthly or every 2 weeks, we're looking at about 15%. The type of interactions have also changed, just to be very clear. At least half of this is really fueled by consumers going into branches to withdraw or deposit cash as well. So transactions that can be conducted through ATMs. They just prefer to do it through ATMs based in branches. But it seems like that proportion of consumers using branches at least once every 2 weeks, at least once every month, remain broadly steady over the last 3 years. And the other two elements that I think are important also to consider in the context of a mobile app and mobile app experience is that the good mobile app experience is not necessarily defined by very sophisticated functionality. Consumers are really looking for ease of use, and speed of login, the design, the speed of conducting banking tasks. Those aspects are often more important in defining good mobile app experience than features, tools, and functionality. And the other thing here that I also think contributes to the growth of digital-only providers is that we're looking at about half of UK consumers telling us that the priority is really around finding ways to make managing finances easier, and they're really keen to try anything. I think that's a really key thing in conjunction with the mobile app and its growing popularity that's creating this fertile ground for digital-only adoption. My final theme in here is around rewards, incentives, and how they're influencing banking behavior. So we know that over the last couple of years, many banks, both incumbent players, but also some of the digital-only banks, have been launching new loyalty rewards propositions to attract customers. A few things that we're seeing in the market when we look at loyalty is that, first of all, the number of consumers who switched the main bank in the last 5 years did not really change that drastically. Although if you look at these percentages here over the last 3 years, so starting in 2022 all the way to 2024, they are slightly elevated compared to where they were pre-2022, but we're not seeing a drastic change in terms of number of consumers switching the main bank. We're looking at about 1 in 5 broadly who have switched the primary provider in the last 5 years. But what we're seeing in the data is, well, two things really. First of all, is that younger consumers are much less loyal. So if you look at how many switch among Gen Z and millennials, we're looking at between a third to a quarter. So much more likely to switch than older generations. And the other thing here is that the two main factors driving switching are incentives and better rewards. But incentives, particularly a quarter of those who have switched because there was an incentive being offered by another institution. And the importance of incentives in driving switching, it's not just visible among younger consumers, but it's also visible among older consumers. Because, we typically expect the younger consumers, their relationships are not as deep, perhaps, with the main bank as older consumers. But if you look at baby boomers, although only 9% of them switched in the last 5 years, half of them switched to access switching incentive, which is higher than among Gen Z. So that power of incentives, the potency of incentives in driving switching is not just visible at the overall market, but younger consumers, but we also see it strongly pronounced among older segments. And it's not just the switching behavior, switching activity that's influenced by incentives, it's the initial decision-making process. So when we look at consumers and the reasons for choosing a certain bank, there are obviously an array of different factors they've considered. But one factor that's really changed over the last couple of years is, again, this importance of rewards and incentives in driving those decisions. To the extent that if you look at consumers who've started the main bank relation in the last 12 months, access to a switching incentive and access to attractive rewards proposition was combined number one factor really influencing the decisions. Again, you see this strong impact of rewards done right really in driving a choice among consumers. And the final aspect is, I already mentioned about the importance of incentives and rewards in driving switching, driving decision-making, but we also see a pretty direct correlation between having incentives on payment cards and being able to capture higher share of spending. So we divided customers into two groups. Customers who earn, or four actually groups, customers earning rewards on the debit and credit cards, and customers who do not have any access on those two different payment methods. And what you see in the data is that those who do are much more likely to use those cards regularly. But also more interestingly, there's very strong impact on spending. So if you look at consumers with rewards on debit cards, they tend to typically spend 85% more on the debit card per month than consumers who do not have access to rewards. If you look at credit cards, the impact is even starker. So we look at 2.4 times the spend comparing to consumers who don't earn any rewards. So you really see is that it's not just the impact on decision-making process or switching. Rewards also quite strongly impact engagement with the provider, the usage of different payment methods. And the final aspect here I wanted to just quickly show it before I wrap up with a couple of calls to action is that, I already spoke about the growth of digital-only providers, the increasing uptake of saving solutions, and overall consumers being just simply more active in the market. If you look at some other aspects here, that consumers do want banks perhaps to improve their propositions across. The aspect of innovation is here. So ongoing innovation is something that consumers really want the banks to maintain a laser focus on. They also want to be able to get easy access to support with queries. And the other thing here as well, which I think is important to call out and corresponds to some other things I mentioned earlier on, is this overall help from the provider to support consumers improving their financial well-being, financial position. This can take form of digital-only tools, PFM tools, but also any guidance that you can provide to consumers that will allow them to better manage their finances. There's, I think a lot of untapped opportunity in the space, and that's something that consumers would value receiving from the providers. So just to sum up, I think we have a couple of key takeaways here, but what I want to focus on are those calls to action. I think there are 5 key things here. The first two are quite closely related. I think banks really need to adapt to fragmentation. It's not just important to have a good current account proposition. Having that is key to acquiring primary relationships. But if you really want to deepen the share of wallet, both asset wallet, but also borrowing wallet, it's important to deliver personalized and value-driven experiences across the whole portfolio of your products and touch points. Looking beyond current accounts, as I said earlier on, there's a high levels of comfort among consumers to shop around for solutions and look beyond primary provider, particularly for things like lending, investment, insurance, but also savings. So that's key factor. I think that's both driving the share of wallet trends that we're seeing, but also driving the fragmentation of relationships that we're seeing. Banks need to really prioritize seamless mobile-first experiences. We see that consumers want or have a high levels of demand for quick and easy banking, and providers really need to deliver on that and keep on the path of accelerated innovation to stay competitive. Enabling smart money management is another thing that we're seeing a strong appetite for within the data as well. And it's not just about having those tools and capabilities for the sake of having them, but it's about creating impactful and tangible experience for consumers. So having tools that consumers can easily interact with, that deliver value, that deliver clarity to consumers, and that enable them to manage their finances more effectively, and they just make the most of the money as well. And the final aspect here is about the opportunity to boost engagement through rewards. We focus in that final section on this, but we can see incentives and rewards becoming more decisive in many ways, not just in driving choice, switching, but also being very helpful in driving engagement. So refining strategies here, it's also really important, how you attract and how you retain and how you deepen relationships with your customers. So I stop here. I'm gonna hand it back to Ashraf now.